What's driving that optimism? How much of it has to do with India's own growth projections?
Hi, good morning. So when you look at India in terms of earnings growth, since March 2020, we've seen a structural improvement where corporate earnings is concerned. So profit to GDP ratios have moved up from a low of 1.4% to about 4.5%. A lot of that is getting driven by demand and domestic demand. Now, what has happened in the first half of FY23 has been that input cost pressures have impacted margins, and that has resulted in slightly lower than expected earnings growth. However, since then, commodity costs have come off quite sharply, and therefore our expectations are that from here on, your margin profile should improve across the corporate sector. Given the fact that we continue to believe that domestic demand remains strong, this year, this is FY23, we expect earnings growth to be in the range of, say, 10 to 12%. And next year, on the back of improvement in margins, earnings should revert back to a mid-teen sort of a profile. Our belief is that if you look at across corporate India, growth will largely be driven by domestic-facing companies, while the global-facing sectors should see some deceleration in terms of earnings profile.
What might be a risk for Indian earnings? I mean, China back into the fray, and it's likely to drive commodity demand higher. That could weigh on costs for Indian companies.
Yes, you're absolutely right. So if commodity cost pressures start to increase once again, that would have an impact in terms of the improvement in the margin profile that we are expecting. At this point in time, while we do expect that China reopening would result in some near-term increase in terms of commodity costs globally, but if you look at where costs were, say, a year ago, costs would still be lower. The second factor to look at is one large sector within the Indian corporate basket, which is driving earnings profile, is the banking sector, where we are clearly seeing evidence of loan growth improving, credit costs coming down, and margins as well improving. And so therefore, this is one large sector, which is a large constituent of the index, which is also driving corporate profitability. Overall, we believe that sectors such as banks, industrials, capital goods, automobiles, which are all domestic-facing sectors, will be the key driver for earnings growth going into FY24. And therefore, our medium-term belief is that while the pace of earnings upgrades is now behind us, and in fact, in the first half of FY23, we've seen some earnings downgrades, but in the medium term, we should still revert back to mid-teens earnings growth profile for corporate India.
Shibani, but we look at multiples here, and it's always a bit higher in India when we talk about price-to-earnings ratios. But we're talking about 23 times earnings at the moment on the Sensex. That's slightly below, would you believe, actually, what we have historically. Why does this premium exist, and would it, do you think, put off foreign investors?
I think you've hit the nail on the head. I think the issue that India faces as a market is clearly valuations. India typically does trade at a premium to emerging markets where price-to-earnings ratio is concerned, and that's because India is a market where growth has clearly been ahead of the competitive emerging market economies, and ROE profile of Indian markets have also improved. But today, when you look at relative valuations are extremely stretched. They are at levels that we have not seen in the past. And therefore, from a valuation perspective, markets are expensive. On an absolute valuation, when you look at Nifty price to earnings on a one-year forward basis, we are slightly above long-term average trends. And that gives us a feeling that in the near term, despite the fact that we expect the medium-term outlook on corporate earnings to remain fairly buoyant, it is possible that in the medium term, we will have to witness or withstand some degree of volatility in markets simply because of the fact that our relative valuations are expensive. India growth outlook remains fairly stable. India clearly is been an outlier in the global context where growth has been concerned. But valuations are something that makes us a little uncomfortable, which is why we believe that near-term volatility is something that we should expect where markets are concerned.